Welcome to The Business Behind Your Business, the podcast where we delve into the financial strategies and insights that drive success for small and medium-sized business owners. I'm your host, Paul Sweeney, and in each episode we bring you expert guests who share practical advice, real-world experiences, and actionable tips to empower you on your business journey. Whether you're a seasoned entrepreneur or just starting out, get ready to uncover the secrets to success and gain valuable insights into the business behind your business. Welcome back. Look, we're recording this episode mid-May, leading up to the end of the financial year in Australia. So coming up to the 30th of June, end of financial year, and already we're being inundated by end of financial year sales promising to get you a better tax deduction. Now, I'm going to say hold off on spending money in the end of year sales. Think about what you're doing, because it's not necessarily the case that you will get a tax deduction for it, but you do need to take in consideration of what's going on in the environment. So end of year sales, look, as a classic example, Officeworks at the moment saying claim everything you can. Everything tech at Officeworks could be tax deductible. Now, the key words there are could be. So you need to be careful about these promises that are coming through linked to the end of year sales about, are they going to be a tax deduction for you? Now, we're focused here on business owners. Now, let's just step back a bit and let's get a bit of clarity around why we have all these end of year sales promising tax deductions. Well, obviously, we have a timing issue here. So all tax years, whether it's in Australia, the UK, US, wherever you are, your tax year runs for 12 months from one date in Australia, the 1st of July, to the 30th of June. So you've got a start date and an end date. Now, the transactions that happen between those dates affect your taxable income. So if we are able to bring forward deductions, spend more money, we're going to bring forward that deduction, then that's an advantage. But if we can defer income past that date, then that's also an advantage for us. So what we're looking at here, though, is not getting caught up in the sales, not getting caught up in the urgency of spending money or the big deals that are out there, because you may not actually need that in your business. Do you actually need that new piece of equipment? It's nice to have, but do you really need it? For every $1 that you're spending, if you're a company, you save 25 cents in tax, but you're still out of pocket by 75 cents. So if you've spent $1,000 on a new piece of equipment, the tax saving you get is $250. You're still out of pocket $750. Now, if you did not need that piece of equipment, if you weren't going to upgrade that piece of equipment, you're out of pocket. And you probably didn't need to spend that money, and that cash that you've spent could be better used to growing your business. So it's very easy to get caught up in that. And Choice Magazine have come out with this sort of explanation, which I think is really good explanation of what's going on in these end of financial year sales, and why there's a lot of emphasis about buy now before the 30th of June. So just quoting from Choice, they're saying that the end of financial year sales recurring at the end of the financial year in Australia, 30 June, attracting billions of dollars in consumer spending. So these end of financial year sales are attracting billions. But what's the motive for these companies offering all these end of financial year sales? It's not because they're really looking after your best interests. They are looking after their interest, and their interest is to make as many sales as possible in the financial year to improve their financial position. They want to improve their financial position because they've got to report to their investors, their shareholders, and they want the maximum amount of profit that they can show on their financial statements. So clearing, getting as many sales, bringing forward as much spending from consumers so that they can bolster their bottom line, so that they can look good to their investors. The other side of it is what goods are on sales, which ones are the most heavily discounted in these sales. Often it's the older product lines or the lines that are going to be replaced by new models. They want to clear the space on their shelves. They want to clear the space in their warehouse to make room for the newer models. So they're offering sales on the older models, the ones which are not going to be as current. They want to clear that from their stock, and they want to get paid for it. So to them, it makes sense to move those models out because they're going to have faster, newer equipment coming in. It's going to be more desirable, but they want to clear out the old. And they want to give you an incentive to buy those older models so that they don't have to store them. They don't have to dispose of them. So they give you the sale. So it sounds like they're giving you a great bargain, but they're really looking after their own interests. So tax planning, let's have a look at it. Look, everybody gets upset about paying too much tax, paying more tax than they need to. And we want to avoid that. And look, tax planning is about understanding your business's tax position, understanding the position you're in, understanding that when you have taxation, you have to pay to the government, and that's a cash flow. And your cash flow is affected by everything else that's going on in your business. But if you're paying out more tax than you need to, that you legally need to pay, then it's reducing your ability, it's reducing your available cash for spending on those activities going to grow your business. So we don't want to pay more tax than we need to. Also, the fact is, once you've paid the tax, you can't get it back. We don't have the ability to carry back losses. Now, during the COVID period, the government graciously allowed us to do that. If we were operating as a company and we were incurring losses during the COVID period, we were allowed to carry back those losses and offset them against taxes from profitable years that we had in the past. But that was just a once-off. That it lasted 3 or 4 years, but that situation is no longer in existence, so we can't carry back losses. So we want to avoid paying more tax than we actually legally need to. Okay, so if we can minimize our tax legally by deferring income legally or bringing forward expenditure on items which are going to give us a tax deduction, items that we are going to need for our business, then we should do that. Every business owner, every taxpayer has the right to manage their taxes and so that they pay the least amount of tax that they're legally obliged to pay. So you should do it. Now, a lot of people don't take the time to do it. And at this time of year, leading up to the end of the financial year, what we're doing with our clients in my accounting and tax business is we're reviewing their likely tax position. We're looking at how profitable are they going to be? What's their taxable income from their business going to be? What tax installments have they been making during the year? What are they going to be obliged to pay in June? Do they have losses from prior periods still that they can apply against their current year income? How is that going to affect the tax? What's their net tax position going to be? When should they be lodging their return? So in Australia, we're fortunate. If you lodge your return through a tax agent, you get access to the tax agent's concessional lodgement program, which means instead of lodging on the 31st of October, you may not need to lodge your company tax return until another 5 months or 7 months even. So it could be May, it could be March, but that gives you longer to pay the tax. So if you are in a situation where your profits have increased considerably and you're going to have a much larger tax bill, then it makes sense to defer physically having to pay that cash, because once you pay it, you don't get it back. But there are also some traps in that. But what we need to do is be aware of the implications of our profit, implications of our spending, the implications of timing of when we do and when we don't spend money. Okay, so as one example of timing in Australia is superannuation guarantee, the super that you pay for your employees. Now, you are legally obliged to pay that within 28 days of the end of the quarter currently. That's the current rule. Otherwise, you pay a surcharge. You pay the superannuation guarantee charge, which is a penalty. But we have, coming up to the 30th of June, the superannuation guarantee for our employees is not obliged to pay that until the 28th of July. But here's the catch. If you don't pay it till the 28th of July, you don't get the tax deduction till the following tax year. So if it's an expense of your business as an obligation, but you don't get the tax deduction till the following tax year, so another 12 months down the track. So if your cash flow allows, you should be paying that superannuation guarantee before the end of the financial year, at least 10 days because of the delays in the transfer of data. So if you're looking to claim the tax deduction for your super obligations, they should be paid by the 20th of June. Okay, so get that in place. That's one easy way to bring forward the timing of your deduction. So we should be looking at that. But what we're looking at with tax planning is minimizing the amount of tax payable. And that could be, utilizing how is that income going to be distributed? How is that income going to be paid? How are we dealing with the profits from our business? What are our options? And this is where you should be getting advice from a registered tax agent, because that is their business. They understand taxes really well. And it's not just about telling you to spend money to increase your deductions. What they should be telling you to do is actually look at the holistic picture of your business, not just now, but what are you planning to do in the next 12 months? What are you planning to do in the next 3 years? Are you looking to purchase equipment? Or what advantage is there in bringing forward the timing of that? Can we finance that to give you an accelerated deduction, take advantage of any concessions that may be in place, any once-off or time-based incentives for purchasing equipment? And at the moment, there could be the ability to get an immediate tax deduction for a piece of equipment up to $20,000 in cost, whereas in the past it used to be $1,000, and otherwise you'd have to depreciate it over 5 to 7, 10, 12 years. But there's an ability at the moment to get an accelerated deduction. So if you're looking to buy equipment, can you bring that forward? Can you finance it if you don't have the cash flow? But if you're looking to finance, you need to start working now. So don't leave it until the last week before the end of the financial year. Start planning 6 weeks, 8 weeks in advance and make sure that happens. Okay, so there's some timing aspects there. So other items we look at is, in terms of our tax planning, is looking at the timing of future cash flows, future payments of tax. Now, the Australian system works that you pay your tax installments for the following year based on your most recent year's income. So we're going to come into a situation in 2024, so this is when I'm recording 2024, where many business owners in 2024, they're going to have a profit. They're going to have taxable income. And they may have been in a situation in the past 3 or 4 years where they've had losses which have accumulated and built up, which meant they haven't been paying any tax and they haven't been paying any installments of tax. But suddenly we're now back in the black. We're back in a profit. So we're going to have tax payable. But as soon as we lodge that return showing tax payable, we're also going to trigger an obligation to pay installments of tax for the future year, for the next year. So we're going to actually have a trigger of having to pay tax on the current year income, which we weren't doing before, and we're not going to have any tax credits because remember we were in a loss situation and we weren't obliged to make any installments of tax. So we're going to pay tax on the full profit. We're also going to be brought into the system where we have to start making installments for next year. So we possibly have a double hit of tax in a very short period. So we need to plan our cash flow. We need to look at our ability to pay the tax and also the timing of when we should be lodging, when we should be paying the tax. Now, the other catch there is in calculating your obligations for installments of tax for the next year, the ATO will look at it and say, well, hang on, you might still be in a loss situation because let's say you made $75,000 of profit, but you got carried forward losses of $100,000. Okay, so in this 2024 year, you're not going to have any tax to pay. But you've used up $75,000 of those tax losses, and they're going to assume that you're going to make $75,000 of taxable income next year as well. That's the only assumption that they really make. But they're going to say instead of having $100,000 of tax losses available, you've only got 25. So you're then going to have, we estimate, or the ATO is going to estimate that your taxable income for the next year is going to be $50,000. Okay. And what they're going to say is, right, on that $50,000 estimated income, you're going to need to start paying installments. So even if you're not paying tax for 2024, the ATO may still say, well, hang on, once you've lodged your return, that shows us that next year you're going to have taxable income and we want to see you paying installments throughout the year. So you need to be mindful of that. So there is a lot of planning in there. So it's not just about tax. It's not just about spending. It's not just about deductions. It's about planning your cash flows, taking advantage of the different tax scales on the ways that we can distribute income to our family members if we're operating, say, through a trust, or who are the shareholders of our company. Looking at the options, should we be paying a dividend? There's a lot of different things to consider in our tax planning. So deferring income, now, in some cases, that's not going to be possible. If you're operating e-commerce, then basically when a customer decides to buy from you, the sale is created. And with e-commerce, you're getting paid at the same time. So you don't have control over deferring income there. But it might be a case of, well, hang on, I've got an option to start doing work for a client and invoicing the last week of June, which is great. And he's going to pay me straight away, which is even better. But if I understand my tax position, I might say, well, hang on, I've got a lot of lumpy income in this current year. And if I bring that forward, it's going to trigger additional tax. But the following year, I'm going to be working less. I'm going to be having some time off. So I know I'm not going to be generating as much income. So instead of starting that work and finishing it and getting paid before the 30th of June, I might say, well, hang on, if it's okay with you, I might defer this until after the 30th of June. Okay, let's defer this until after the 30th of June, and that way the income goes into the following year. The following year, the tax return is not done until after the 30th of June 2025, so 12 months later. You're pushing that recognition of revenue further down the track. So that can be an advantage. So that's the sort of thing we're looking at. But again, remember, it needs to be in compliance with the law. You've got to do it in compliance with the tax law. So we must be aware of the law. And that's one of the things where a lot of business owners, I find, they don't really understand what their tax obligations are. So if you're in that situation where you don't understand, you should be getting on top of that. You should understand there are a lot of free tools from the ATO helping you to understand your tax obligations, or work with an accountant and registered tax agent. That's probably the best option, because they're going to be looking at it from all aspects of giving you the best result, not just in your tax, but helping you run your business better. And if they're not helping you by asking you questions about how you want to grow your business, how you want to be more profitable, how you want to improve the way your business supports you and the goals that you have set, then it might be time to think of another accountant. So that's a conversation to have over the dinner table, maybe when you're thinking about, well, where are we really heading with our business? Okay, tax is important. The effect of tax on your cash flow is important. But at the end of the day, the key things are about running your business better, running it more profitably, getting more sales, getting more revenue, getting more profit, being more efficient. Tax is a consequence. Now, I always say that I would rather pay, say, $75,000 of tax than $750 of tax. And the reason would be is that I've actually generated a lot more income to be in a situation where I'm paying $75,000 of tax. Okay, I'm in a lot more income producing situation. I've got the cash. I'm much better off financially by being in a situation where I have to pay the tax. Okay, because I've generated more profit. I'd much rather that than be making a loss. The easiest way to pay no tax is to make losses. But you can only sustain that for a short period of time because you've got to keep funding those losses. And that's not the goal of being in business. The goal of being in business is to make profit, create value, improve your lifestyle, support the goals, the things that are really important to you. It's not just about tax. So when we talk about minimizing tax, we're talking not just in terms of the dollar value, but in terms of the proportion of your income, of your total income. So keep that in mind as well. So a lot of things to consider there with tax. Maybe you've not thought about tax planning as such, but it's a conversation you should be starting to have with your accountant and your advisor. And so I encourage you to do that. So whatever situation you're in, and maybe it's a case of, well, hang on, I'm not missed the boat for this year, but let's start planning next year and think about the tax consequences of what we're doing. Now, one final tip I want to leave you with today is why we monitor our tax planning and our scheduling, our cash flow. Often we find that people's income changes from year to year. And one of the things I regularly see is that somebody had an injection of income and they might have sold an asset and had a lot of capital, or they may have had some extra income from a business, and they're paying tax based on that. But this year's situation is different. They may have accessed some tax concessions which gave them some higher deductions. But what we often see is people overpaying their installments of tax. Overpaying because they've ignored that their current year income position is going to be different. So they've been paying money to the ATO, and often we're talking tens and $20,000, which is a lot of money. But they've been paying that to the ATO unnecessarily. So at the end of the day, when they lodge their return, they get a refund. And now these people who are not paying close attention to how much tax they're paying in their installments, often not on top of when they need to lodge their return. So they've been paying more tax than they need to, and they've taken longer to lodge their return, so it takes longer to get the refund of that overpaid tax. So be mindful of changes in your situation and be careful about paying more tax than you need to. So time to think about it. Okay, we need to manage our tax. We need to make sure we're not paying more tax than we're legally obliged to, but don't get sucked into all this, I guess, the fear of missing out of all these end-of-year sales. Think very carefully about what you're spending. Do you need to spend it? Is it actually going to be a benefit to your business? Not in terms of just getting you a tax deduction, because you don't get the full value, but is it a benefit to your business in terms of enabling you to grow your business, to be more profitable, and to have a better lifestyle? So I'll leave you with those thoughts. I look forward to you joining us in future episodes. We've got some great guests lined up and looking forward to sharing those conversations with you. So thanks for joining us again today, and looking forward to keeping the conversations going. That's a wrap for this episode of The Business Behind Your Business. We hope you found today's discussion insightful and valuable for your business journey. Before we go, don't forget to subscribe to our podcast on your favourite platform. Share it with fellow business owners who could benefit, and send in your burning questions, because we love hearing from you. Missed any of our previous episodes or looking for additional resources to help grow your business? Head over to our website at thebusinessbehindyourbusiness.com. There you'll find our full archive of past episodes, along with show notes, transcripts, and links to valuable resources mentioned in each episode. Your journey to business success continues at thebusinessbehindyourbusiness.com. Until next time, stay inspired, stay informed, and keep building the business of your dreams.